Just a few days ago, the gold market was in a violent freefall. A sudden, brutal pullback that wiped out billions and left investors everywhere asking the same question. Is the bull run over, or is this just a pause before the next leg up? We're going to dig into the data and find out.
First, let's just get a sense of the scale of this shock. We're talking about a drop of $816 in just 2 trading sessions. Now, this wasn't some slow, grinding decline. This was a sudden, violent event that really tested the market's core.
And this drop created a fascinating puzzle. You see, on one hand, you had these massive headwinds that should have kept gold down, things like high real yields and a strong dollar. But on the other hand, gold staged this incredibly rapid and resilient rebound. So what's really going on here?
That brings us to the central question we have to answer. How on earth did gold seem to defy financial gravity? The answer, as you'll see, isn't in the usual places. It's hidden deep inside the market's plumbing and a huge structural shift in who is actually buying gold today.
So, first things first, let's unmask what actually drove that sell-off. Our analysis shows it wasn't a sudden change in the fundamentals. No, this was all about positioning and the internal mechanics of the market itself.
And this is the single most important point to understand. The sell-off was a technical event. It was all about deleveraging, a rapid unwinding of bets, not a fundamental collapse in actual demand for gold. That distinction is absolutely critical for figuring out what happens next.
Here's the evidence. Just before the price collapsed, speculative traders, the fast money, were holding a massive net long position of more than 205,000 futures contracts. The market was absolutely packed with bullish bets, and many of them were on leverage.
Now, to put that in perspective, that single position made up 42% of all the open interest in the market. You know, when you have that many people crowded onto one side of the boat, it doesn't take much of a wave to cause a big problem. The market structure was just inherently unstable.
And then that wave hit. It came in the form of a volatility spike. As the gold VIX shot up, it kicked off a brutal chain reaction. First, internal risk limits at all these funds were breached. Then, liquidity just vanished. That combination forced all those leveraged longs to sell at any price they could get, turning what should have been a minor correction into a complete waterfall decline. It was purely mechanical.
Okay, so if the crash was mechanical, what explains the incredibly strong rebound? I mean, where did all that buying come from? The answer is a fundamental change in the market structure. We need to look at the new sources of demand that are putting a floor under the price.
Just look at this chart. It shows a really profound shift. In 2025, for the first time, investment demand at over 43% officially became the biggest single piece of the gold demand pie, bigger even than jewelry. This means the market is now driven more by investors than by consumers.
And the numbers behind that are even more dramatic. While you saw jewelry and central bank demand fall off a little bit, investment demand absolutely exploded, surging 84% year over year. This is a new class of investor, and they see big dips as buying opportunities, which creates a really powerful floor under the price.
The second pillar supporting that floor is the official sector. Central banks bought another 863 tons for their reserves in 2025. You have to remember, this type of demand is strategic, it's long-term, and it is largely insensitive to short-term price swings. They are consistent buyers, especially on weakness, and that helps absorb a lot of the speculative selling. By the way, if you're finding our analysis valuable, please take a moment to like, share, and subscribe to our channel. It really helps, and it ensures you won't miss our future updates.
So now that we understand the market's new structure, what's the path forward from here? To figure that out, we need to analyze the key macro triggers that are going to dictate gold's next move.
And really, it all comes down to one single variable, the real yield. It's pretty simple. It's just the yield on a government bond after you subtract inflation. You can think of it as the opportunity cost of holding an asset like gold that doesn't pay you anything. So when real yields go down, gold gets more attractive. And when they go up, gold gets less attractive.
Looking at where we are now, in early February 2026, the environment is still pretty challenging. You've got high nominal yields, and the 10-year real yield is a major headwind at 1.94%. The fact that gold has performed so well against that backdrop tells you the market is pricing in other things, like maybe a premium for geopolitical risk.
So this framework allows us to map out 3 clear scenarios. Our base case is that if real yields just hang out where they are, gold will probably consolidate in a choppy range below its old highs. The bull case gets triggered if real yields start to fall, which would lower that opportunity cost and could easily send gold back up to retest its peaks. But the bear case is that real yields rise even further, and that could definitely trigger another wave of forced selling. The direction of real yields is everything. So to bring it all together, while the structural demand picture for gold looks really robust, the outlook isn't without its risks. There are 3 core macro threats that investors really need to be watching.
Here they are, the 3 big ones. First, and this is the most important, another big rise in real yields would put serious pressure on gold. Second, a sustained broad rally in the US dollar would be a significant headwind. And third, given how much money has flowed into gold ETFs, we can't ignore the risk of major outflows if we suddenly enter a big, risk-on phase in the markets.
So that leaves us with this final question. The evidence clearly points to a new structural floor for gold, one built on strong investment and official sector demand. But we know that floor is going to be tested by these powerful macro forces. So, of the risks we've just outlined, which one poses the single greatest threat to breaking that floor and shattering gold's new equilibrium? The answer to that question will likely define this market for the rest of the year.